Good morning, everyone. Today is a hugely significant day. We've agreed to be a key part of the consortium delivering the Sizewell C nuclear power station in Suffolk, a critical piece of infrastructure for the UK that will keep energy secure, affordable and sustainable for households and for businesses for many decades to come. This cements our position as the largest UK investor in nuclear energy. Russell will take you through the financial details shortly, but before he does, let me explain why this is such an important deal for all stakeholders. As I said in February, the energy system is changing faster than ever, and the pace of change will only continue to accelerate. The trends that will shape the future are becoming ever more evident. More electrification, more renewables and therefore more intermittency, and more demand for bespoke customer products and services. The implication of those trends are quite stark. Despite a tilt towards electricity and massive growth in renewables, the world is still emitting more carbon than it's ever done before. Growing intermittency is increasing the call on generation sources that can produce power reliably when the sun isn't shining and the wind isn't blowing. It's clear that we need more backup generation. We need more storage. We need more zero carbon baseload. An additional 24 gigawatts of nuclear power is needed by 2050 to balance the market in the UK. Hinkley Point C and Sizewell C will provide around 1/4 of that amount. Now, Sizewell B may still be operating, but the rest of the current nuclear fleet will have shut down by then. So we need to build at least 6 more Sizewell Cs. That's why we've been investing in nuclear for well over a decade. It's why we're so proud to be a key part of the UK's nuclear renaissance, with today's announcement bringing our skills and experience to this vital project. And it's why we're keen to do more in the future, of course, subject to delivering the right returns that are a foundation of our strategy. Once built, Sizewell C will provide vital energy security for the UK, generating affordable zero-carbon baseload to 6 million homes, equivalent to about 7% of current demand for at least 60 years and likely much longer than that. Now's the right time to be pushing ahead with this project. We can learn from the other EPR projects such as Hinkley Point C, and we can deliver better performance as we rebuild our nuclear power station muscle. If we don't do this, those skills, that experience will drain away, and so will the ability to build the assets that the UK needs for the future. If we simply develop 1 or 2 plants every 30 years, we will never, ever be brilliant at it. Developing power plants is complex, nuclear especially, and that's why the development plan is so important. We've done our own technical due diligence. We believe the plan is deliverable. We believe the cost estimates are realistic, and we believe the regulatory framework strikes the right balance between risk and reward, allowing us to invest with confidence. But experience matters, and that's why we're so pleased to be investing alongside EDF, La Caisse, Amber, and of course the UK government. For the first time, the British people will be co-owners of a nuclear power plant, with consumers benefiting from cheaper, cleaner power for decades to come. Now, we've worked with EDF for over 15 years. We see them up close on a daily basis. They are first-class operators with a strong safety culture. We're also delighted that La Caisse and Amber, experienced infrastructure investors, are part of the team. Their insights will be invaluable. Sizewell C will be EDF's 3rd new nuclear project in Europe over the past 20 years. And whilst Flamanville and Hinkley have had their challenges, the high level of replication across the projects, particularly relative to Hinkley, gives us confidence that Sizewell can take another step forward in efficiency. Centrica will play an important role during development. Building on a brownfield site next to our Sizewell B plant allows us to leverage existing relationships across the industry to create more synergies. There's a large team on site already, with many more due to roll straight from Hinkley onto Sizewell, ensuring critical learnings already benefiting Unit 2 at Hinkley are transferred directly from one project to the next. Sizewell C will create over 10,000 direct jobs during construction, with thousands more indirectly. It will also support several thousand British supply chain businesses and create around 1,000 jobs during the operational phase. Long-term, stable, highly skilled, highly paid jobs. Now, I'm personally committed to improving social mobility, and I'm therefore delighted that this will also create 1,500 apprenticeships, with over 1/3 of those coming from the local area. We've got a long track record of supporting growth in engineering skills, and this will build further on that. When we launched our strategy in 2023, we laid out how we would position Centrica to thrive through the energy transition, how we would deliver returns to our shareholders whilst ensuring energy remains secure, affordable and sustainable for our customers. We told you we would focus on operational excellence. We told you we would focus on commercial delivery. And there's still much more we can do on both, but the progress we've made so far has been clear. And we told you we'd invest for value, disciplined investment to grow the infrastructure leg of our portfolio, with a clear target to increase our share of regulated and contracted earnings. The structure we've announced today is a huge step on that journey. A long-term regulated asset with a tried and tested, stable framework governing returns. Now, I'd personally like to thank the many people across Centrica who've made this happen and brought another exciting asset into our portfolio. I'd also like to thank the UK Government, in particular the Chancellor Rachel Reeves and her team at the Treasury, and the Secretary of State for Energy Security and Net Zero, Ed Miliband, and his team. The framework they've designed addresses the key constraints to developing critical national infrastructure. This is good for the country and the value is clear. The value to Centrica is also clear. We're acquiring a 15% stake in Sizewell C. Our total funding obligation is capped at £1.3 billion, and it will generate an allowed real return on equity of 10.8% fixed through the entire construction phase. So what does that mean for us? Number one, earnings that grow steadily through construction, de-risking delivery of our £1.6 billion 2028 EBITDA target. We expect pre-tax profit contribution of around £50 million a year by 2028, which should go to around £150 million by completion of construction and roughly double from that after the initial startup period. Number two, a base case IRR of 12% with incentives to deliver ahead of budget. Number three, an equity share of the regulated asset base of around £3 billion by the commencement of commercial operations. Number four, predictable returns aligned with our financial strategy. And the structure we've agreed means phased investment, a cap in our funding obligation, and no delay in our capital producing returns, meeting the red lines we set out initially. Hard work over a long period, allowing us to invest confidently whilst providing value for money and certainty of delivery to consumers. Now, creating options is a core part of our strategy. Options to make multiple returns from a single asset through our retail and our optimisation businesses, or options to invest further in the future. We've got both of these with Sizewell. We've got an agreement in principle to take our 15% share of zero carbon electrons, which are enough to power around 1 million homes, creating a block of long-term base load zero carbon power that we can both optimise through Centrica Energy and supply to our customers. We've also agreed in principle to provide route-to-market services for Sizewell C for the first 20 years of operations. Longer term, Sizewell C can participate in ancillary services such as frequency response, and heat and hydrogen may also be options on site. Some of these are under discussion already and would further strengthen UK energy resilience whilst generating investment opportunities for us. These are all valuable options for Centrica, all valuable options for the UK, and all valuable options for our partners. As the project develops and is de-risked, the government may look to crystallise more value for taxpayers by reducing its stake. And I'm really pleased that we've got a right of first offer to increase our stake should that happen. Russell will now take you through a little bit more of the financial detail.
Thanks, Chris. This is a really important transaction for Centrica. Our financial framework is designed to make Centrica the highest quality company we can be. More stable, more predictable, growing our business while also delivering reliable shareholder returns. And disciplined investment in regulated assets is a key part of that. Doing the right deal that creates value for our shareholders takes patience and hard work. And for Sizewell C, I'm confident it has been worth the effort. Now, there are some complexities, but at its core, this is really quite straightforward. Sizewell C will operate under the same well-established RAB framework which has supported hundreds of billions of pounds of UK infrastructure investment over several decades. The 10.8% real return on equity fixed through the development and early operations phase is comfortably above our return thresholds, delivering a 12% IRR. And the structure addresses the risks we needed to mitigate, particularly on costs and schedule overruns. Our investment obligation is capped at £1.3 billion, which generates a cash yield during construction of around £700 to £800 million, lowering our net cost. There are incentives to deliver the project ahead of budget, and the impact on returns from delays is modest. And the government is providing a broader support package which reduces exposure to other risks during both construction and operations. So we have a clear line of sight on the size of our investment and the returns we'll earn, with appropriate risk mitigation in place. Investing in Sizewell C continues our journey of making Centrica more predictable. It adds around £50 million worth of EBITDA from regulated and contracted activities by the end of 2028, enhances our balance sheet and supports our ability to create more value across the group. Let me now take you through a bit more of the detail. So today's a major milestone for the project, but there's still a bit of process to be concluded before revenue commencement, when we will start funding the project, and we're expecting that to happen later this year. The regulatory framework we've announced today covers that entire period, after which Ofgem will set allowed returns on a similar schedule as it currently does with networks. Of course, we don't know exactly what the returns will be at that point, but Ofgem has recognised the need to set an appropriate return for Sizewell during operations, reflecting the fact it is a single asset without the same diversification benefits as a typical network. That's important. We will contribute our share of capital over time, and the phasing of development means that we currently expect to invest around £500 million by the end of 2028. The allowed return for the project as a whole of 6.7% assumes 65% RAB gearing, a cost of debt of 4.5% and a cost of equity of 10.8%. Importantly, debt costs will be passed through as allowed revenue, so financing costs do not represent a risk to our return profile. The main incentives relate to delivering the project on time and below budget. Let me unpack that a little bit further. The Sizewell C capital cost estimate is £38 billion, with a commercial operations date in the mid to late 2030s. We'll be doing all we can to support the team in achieving that, or even better. The regulatory framework incentivises the most efficient delivery possible, with two important cost thresholds set by the government, the lower and higher regulatory thresholds. The lower regulatory threshold, LRT, is based on a moderate scenario and represents the point at which cost-sharing mechanisms kick in. The higher regulatory threshold, HRT, is based on a severe scenario. You can see details of each in the appendix, including an assumed 4-year delay at HRT. We see HRT as a very unlikely outcome. Our investment obligation is capped in all scenarios, with the additional costs associated with HRT largely funded from the return the project is generating by that point. Going through the range of scenarios, there is a clear incentive to deliver the project ahead of LRT, with 50% of any cost saving below that threshold added to the RAB. Between the LRT and HRT, 50% of additional costs are added to the RAB. And crucially, beyond HRT, our funding obligation ceases, although we have the option to continue investing if we want. If further funding is not available in the market, the government steps in, with no impact on the RAB we have already accumulated to that point. At the LRT, our return is over 12%. At HRT, it remains above 10%. It's also worth noting that the HRT scenario includes a 50 basis point reduction to the allowed WACC during the last 2 years of the 4-year assumed delay beyond the LRT schedule. However, that reduction only applies in the period of the delay and is removed following commercial operations, so the impact on IRR would be minimal and would only be relevant from the early 2040s. Our investment will take two forms: 90% via a shareholder loan and 10% via a share capital injection, and collectively this will be treated as equity. The shareholder loan will earn a fixed interest of 9%, part paid in cash with the balance accrued. The project's return will be distributed in two ways: a cash yield during construction and an amount retained in the company to fund CapEx directly. As is typical with these frameworks, returns are also adjusted to ensure we are compensated for the effects of inflation. The cash yield during construction is fixed at 6% on our gross investment into the project, being the full £1.3 billion. In effect, that means the investment is partially self-funding, with a cash yield during construction expected to be around £700 to £800 million. The return retained within the project will fund our share of equity RAB, growing to about £3 billion by commissioning, assuming a typical inflation curve. And once you include project debt, that gives a total Centrica RAB of around £8 billion. So you can see we have underpinned returns during the full construction and early operation phase of this project. And the financing structure means that earnings and cash returns will accelerate thereafter. Now that's driven by three main factors. First, the accrued interest retained in Sizewell C above the yield cap during construction is added to the shareholder loan, with a repayment schedule that begins from commercial operations. Second, following commercial operations, the yield cap is removed and the project re-gears to 65% of RAB, further supporting distributions. And thirdly, following the post-construction review date, depreciation allowances kick in, delivering a significant increase in Sizewell's allowed revenues and supporting further shareholder distributions. In addition, Sizewell will also have incentive mechanisms available during operations which could further improve returns if the plant performs well. These dynamics mean we expect our full investment to be recouped within a few years of commercial operations, even under the HRT scenario. Ensuring that the project delivers the right risk-adjusted return has been a real focus, and we're pleased with the package of measures we've agreed. The allowed returns, cost cap and investment phasing are all important aspects of that. The government has also put in place a broader support package to provide protection against low probability, high impact risks, including project discontinuation, refinancing and outages, amongst other things. And, like with the operational nuclear fleet, decommissioning will be funded through levies during operations, so we face no long-term liability there. Those are crucial mechanisms that gave us the confidence to invest. It's also important that we're able to exert the right amount of influence through the shareholder agreement and our position on the board, with fundamental decisions requiring the approval of all 10% plus shareholders and a 75% voting threshold for other key decisions. We're confident we've been able to achieve that. So let me turn now to how Sizewell C will flow through into the financial framework we've been outlining to you. The £500 million total investment we anticipate by the end of 2028 means that we now have 2/3 of our total programme committed. There is no change to our priorities for the remaining amount. Attractive returns are a foundation, and any opportunity has to align with the strategy. Combining the investment in the meter asset provider, Irish Peakers and now Sizewell C, we have around 1.7 billion of the investment programme going into regulated or contracted assets. We would like to increase that proportion further with the remaining capacity, and as we said before, we continue to review a broad range of opportunities. I'm pleased to say that this is an investment that will deliver earnings accretion from next year, and that will build steadily over time as the regulated asset base grows. With Sizewell C's contribution, around 90% of our £1.6 billion EBITDA target is coming from activities or projects underway today. And the Sizewell contribution will continue to grow strongly from there to about £150 million by commercial operations, accelerating rapidly thereafter as we move into the operations phase. Cash returns on our investment will also start from next year, although free cash flow will obviously be negative for the foreseeable future as we build the plant. So let me summarise. Sizewell C is going to deliver huge benefits to the UK energy system, and it will also support Centrica to deliver against our financial framework. Over time, Sizewell will help us grow earnings while reducing volatility, supporting our balance sheet and helping us create value across the broader business. It underpins our medium-term earnings targets and our ability to continue progressing our dividend. And I should also say that there is no change to our ongoing share buyback programme. With that, I'll hand it back to Chris.
To finish, let me reiterate just how delighted we are to be investing in this project. Sizewell C is critical for the future of the UK energy system. The secure, affordable and sustainable baseload power it delivers, together with the highly skilled jobs and apprenticeships we create, will benefit the country for many, many decades to come. So there is huge responsibility on us to deliver this project. We're delighted to have world-class partners alongside us, providing confidence to all stakeholders that this can and will be delivered on time and on budget, or dare we say it, even better than that. At the same time, a well-established, stable, long-term regulatory framework gives us the confidence to invest. Visibility on our returns, appropriate risk mitigations, and future optionality. This is what we mean by investing for value. Investment that supports our earnings whilst making Centrica more predictable. Investment that supports our shareholder returns. An investment that creates a more solid platform to support future growth. This is a great deal for the UK, and it's a great deal for Centrica.